A single policy shift can send the entire market into a frenzy, and the hidden driver behind every rally is the president in the White House. Stay tuned, because number one is a factor most investors overlook. Surprisingly, the Great Depression era introduced the first massive federal stimulus that reshaped market expectations. When Franklin D. Roosevelt launched the New Deal, his administration poured unprecedented public works funding and created agencies like the SEC to restore investor confidence. Although the economy was still fragile, the infusion of government spending boosted corporate earnings and laid the groundwork for a post-war boom. Historians note that this fiscal expansion altered how traders viewed the relationship between policy and price, making the market more responsive to political signals. The legacy of those early interventions still echoes today, reminding us that massive government spending can be both a lifeline and a catalyst for market volatility.
Consider the early 1950s, when President Eisenhower embraced moderate tax cuts and a stable fiscal stance. By reducing the top marginal rate modestly, the administration aimed to spur consumer spending without inflating the budget. This balance coincided with a booming manufacturing sector and the rise of suburban America, creating a fertile environment for equities to climb steadily. Analysts point to the period's low inflation and steady GDP growth as evidence that measured tax relief can nurture market confidence without sparking panic. The era also underscored the importance of predictable policy. Investors rewarded the administration's restraint, setting a tone that would influence future tax debates for decades.
During the 1970s, the market faced a perfect storm of high inflation, stagnant growth, and exploding oil prices that tested every administration's resolve. President Nixon's decision to impose wage and price controls attempted to tame runaway inflation, but the policy backfired, eroding investor trust. Simultaneously, OPEC's oil embargo sent energy costs soaring, squeezing corporate profit margins across the board. The resulting stagflation forced the Federal Reserve to adopt tighter monetary policies, further pressuring equities. Scholars argue that this turbulent decade taught markets to react sharply to both geopolitical shocks and domestic policy missteps, highlighting how external crises can amplify the impact of internal economic choices.
One of the most dramatic policy turnarounds arrived with Ronald Reagan's 1980s agenda, famously dubbed Reaganomics. By slashing the top income tax rate from 70% to roughly 28% and championing widespread deregulation, the administration aimed to unleash private sector growth. The result was a surge in corporate profitability, a booming stock market, and a cultural shift toward free market optimism. However, critics note that the era also saw rising income inequality and mounting federal deficits, factors that later contributed to market corrections. Still, the period demonstrated how aggressive tax cuts combined with deregulation can ignite a bullish market, while also sowing seeds for future volatility.
Hidden in the late 1990s, President Clinton's fiscal discipline produced a rare budget surplus that coincided with the explosive rise of internet companies. By maintaining a balanced budget and supporting modest tax increases on the wealthy, the administration fostered a climate of confidence among investors. At the same time, the dot-com boom drove unprecedented equity valuations, creating a feedback loop where fiscal stability reinforced market enthusiasm. While the subsequent bust reminded analysts of the perils of overoptimism, the era illustrated how a combination of prudent fiscal policy and emerging technology sectors can together propel the market to new heights.
Few people know that George H.W. Bush's successor, George W. Bush, introduced a series of tax cuts in the early 2000s that reshaped investor expectations. The 2001 and 2003 reductions lowered the top marginal rate to 35%, aiming to stimulate consumer spending and corporate investment amid a lingering recession. Initially, the cuts buoyed equity markets, but the subsequent accounting scandals and the 9/11 attacks created a volatile backdrop. The era revealed that tax relief alone cannot shield markets from external shocks, and that investor sentiment can swing dramatically when policy meets unforeseen events.
In the wake of the 2008 financial crisis, President Obama launched a $787 billion stimulus package, while the Federal Reserve pursued quantitative easing. This coordinated fiscal monetary approach aimed to revive demand, stabilize banks, and restore confidence. The stimulus injected cash into infrastructure projects and unemployment benefits, while the Fed's asset purchases kept interest rates near zero. Together, these measures helped the S&P 500 recover from its lows, marking one of the longest bull markets in history. Economists credit this synergy for dampening the recession's depth, showing how aligned policy tools can accelerate market rebounds.
When President Trump took office, he pursued an aggressive trade agenda, imposing tariffs on China, the EU, and other partners. The resulting trade wars introduced uncertainty, causing short-term market jitters as supply chains scrambled. Simultaneously, the 2017 Tax Cuts and Jobs Act slashed the corporate tax rate from 35% to 21%, igniting a sharp rally in equities as after-tax earnings projections rose. The juxtaposition of protectionist measures and tax relief created a roller coaster environment, teaching investors that conflicting policies can coexist, each tugging market direction in opposite ways.
Finally, the current administration has rolled out a massive infrastructure plan, proposing trillions in spending to modernize roads, broadband, and clean energy. While these investments promise long-term growth, they also raise concerns about financing and rising inflation. Early 2023 data showed consumer prices climbing faster than in recent decades, prompting the Federal Reserve to tighten monetary policy. This tension between expansive fiscal initiatives and tighter money supply has kept traders on edge, illustrating how simultaneous stimulus and inflation fears can generate mixed market signals.
Ultimately, the story of U.S. administrations and market performance points toward an increasingly complex dance between policy uncertainty and investor resilience. As future presidents grapple with climate goals, digital taxation, and global competition, the market will likely continue to react sharply to both announced reforms and unexpected events. Yet history shows that despite turbulence, equities have a remarkable capacity to adapt and recover over time. Keeping an eye on fiscal, regulatory, and monetary cues will remain essential for anyone trying to understand where the next market swing might originate.
We've journeyed from Roosevelt's bold fiscal surge to today's policy uncertainty, seeing how each administration rewrites the market script. Understanding these forces gives you a clearer lens on why stocks rise and fall beyond headlines. If you enjoyed this deep dive, subscribe so you don't miss the next mind-blowing list we drop each week. Which presidential policy surprised you most? Let us know in the comments below. And if you found value in the story, give it a like to help the channel grow. Thanks for watching.